The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I'm Michelle Hebert, Director of Communications here at Saney's, and welcome to another Lunch and Learn in our ongoing Financial Friday series. Saney's is excited to offer these sessions in cooperation with our corporate partner, AXA. AXA has a long-standing presence in New York, and a large portion of AXA's New York client base is built upon the work they do within the public education system. Through AXA, Saney's members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Saney's members, which we urge you to take advantage of. It's a really great benefit. Our AXA presenter today is Alex Bianco. So welcome, Alex. And before we get started, please note that all participants are muted during the session, during the presentation, but we'll have some Q&A time at the end. And if you have a question, you'll see a questions panel in your control panel to the right, I think it should be. So just type your question in there and we'll get to your questions after the presentation. We're also recording the session and it'll be available on saneys.org, and I'll email all of you with that registration link if you want to review the presentation and that sort of thing. So with that, I'll turn it over to Alex.
Great, thank you very much, and welcome everybody for joining our presentation today. And today we're going to be talking about 10 financial myths, demystified. If you're like most people, you probably may have some misconceptions about planning and could potentially be unaware of the appropriate strategies to help you move towards your goals. So what we're going to do today is talk about these 10 common financial myths and then list some ways that you could potentially plan around these. We're going to talk about general planning, insurance strategies, investment strategies, retirement planning, and a few estate planning strategies. And the goal really is just to give out some information to help enhance and protect your assets and allow you to make the most educated decision that you possibly can. So let's get started with some general planning needs here. Myth number 1, I'm still young. I can wait another few years before I start saving. The truth is, tomorrow always seems like there's plenty of time, but tomorrow has a way of coming today very, very suddenly. And the cost of procrastination is very expensive. This is a hypothetical chart that shows the earlier that you start putting away funds, the longer the time frame they'll have to accumulate, and therefore the lower amount you really have to set aside to meet your specific objective. If we look at the top, assuming a 7% annual rate of return, there's a 25-year-old with 40 years until age 65. That 25-year-old invests $189 a month and will have $500,000 at age 65. Notice that the 25-year-old only invested, though, $90,900 of that $500,000 total. So the other $409,000 comes from compounding returns. So the money had a long time to grow upon itself. Therefore, there was a lot less contribution that went in versus if we look at the bottom, someone starting at this extreme now at age 50, to reach that same $500,000 goal by age 65, assuming the same 7% rate of return, the 50-year-old must invest $1,568 a month. More than that, the 50-year-old contributes $282,000. So the 50-year-old put in a lot more money over a very short period of time to achieve that same $500,000 goal. So time really can be one of your biggest allies, or it can be one of your biggest enemies, depending on how you use it. And the message really on this myth is no matter how old you are, just start. Myth number 2, we're going to look at potentially paying for some children's education. So the truth is there's a lot of different methods to save for college education. We have the educational IRA, which is known as the Coverdell Education Savings Account. That limits you, though, to $2,000 a year as a contribution. There's also the New York State 529 plans for us here in New York. Those do have the same exclusion rate as gifts, which is $15,000 here for 2018. And if we look at the cost of tuition, if we look at a 4-year private school in 2017, 2018, it's $34,000 a year. And for a public school, $9,900 a year. So this is definitely not a cookie cutter approach here. There are many tools to use to help save for college education. It could be a combination of some of these. And then some of them aren't listed on here, such as a Roth IRA or using cash value from life insurance. It really just depends on each person, each family, their financial situation, what's feasible, what's going to help them out tax-wise, and really what gives them the most options and flexibility when it comes to saving for college education. Myth number 3 here is the best gift I can give to charity is money. So we've probably all given money to charity at some point, but really what's the most beneficial way to do that? So the truth is, if you give cash to a charity, there could be an opportunity that's missed. So most charities, as long as we're gifting them, they don't pay any taxes no matter how those assets get in their possession. So we can give cash to a charity right from our checking accounts, our savings accounts, right from our pockets. But if we give $100, they get $100. There are other ways that we can give to charities. So we can take investments potentially that we have and gift those assets. And the best part about that is they do not have to pay any taxes on the gains. So it can really be used as some leverage of our dollar that we're contributing to charities if we can pick and choose the right vehicles to do it with. Let's take a look here at the cash equivalent versus, let's just say there was a stock that someone held. So again, you can give $1,000, you receive $1,000 tax deduction, and the charity gets that $1,000. Or if you had an investment that you purchased for $1,000 and has now grown to $1,500, you can gift those shares to that charitable organization. They receive the full amount and they don't pay any taxes on it. Lastly, there's life insurance. And this is always a tricky subject when it comes to any charitable organization. They almost always want their donations right away. But this is a way that someone can really leverage a dollar and potentially leave behind a great benefit to a charity. They might have charity own a life insurance policy on them, or they could potentially just put a charity as a portion of a beneficiary on their current life insurance policies. Next, we're going to talk about some myths associated with insurance. So let's go to myth number 4 here and read this slide. And it says, my medical insurance will cover any unexpected illness that comes my way. Long-term care is defined as a skilled care provided either in home, at an assisted living facility, or at a nursing home. The cost is actually staggering. The average cost nationally for a semi-private room in a nursing home was over $7,000 per month. And a lot of people think that medical insurance or Medicare will help out. They may, but they may not. Some medical insurance policies carry exclusions, limitations on long-term care, and the same goes for Medicare coverage. While Medicare does cover some home health skilled nursing and hospice care, it's not a long-term care insurance program. It covers relatively short-term care. There are separate policies that can be put in place right directly through long-term care insurance. And now there's also some options out there through life insurance. So long-term care insurance is, it's great if it's actually used. But what we've seen is the cost has went up a little bit over the last couple of years. And we're always worried about putting something in place that there could potentially not be seen a benefit from. So there are life insurance policies out there. Let's just say it's a $300,000 life insurance policy that if somebody puts a long-term care services rider on that, they can actually access tax-free some of their death benefit dollars to pay for long-term care. We really like that because we know one way or another that that benefit is going to be paid out. It's going to be paid to a nursing facility, or it's going to be paid upon someone's passing. So something to think about. There are different eligibility requirements for these types of things, but again, like we said, there's been some rising of costs in the long-term care landscape over the last number of years, and again, we really want to be efficient with what we're paying for premiums and what we're getting out of it in terms of a benefit. So moving right along here to myth number 5. So I have life and disability insurance through my job. I don't need any more. So we hear this a lot, and especially, when we're New York State employees here, there is a lot of benefits that come along while we're working, and then a lot of benefits that come along when we retire. But let's take a look at just some statistics here. And a disabling injury actually occurs every 1 second, and a fatal injury occurs every 4 minutes. And injuries happen from a variety of different circumstances, from car and home accidents, environmental hazards, mental, physical, medical conditions. So you might think that you have coverage through your company or some sort of group policy. And the fact is that many of these group policies, they offer either minimal or very restrictive coverage. If you leave your job for any reason, even retirement, you may lose coverage, or you may see a drastic reduction in the coverage that you have. They might want you to convert it potentially to an individual policy, or you could lose it. So I know through a lot of the school districts around the state, there's these supplemental life insurance policies that we can buy right out of our paycheck for ourselves or even for our spouses. Anything that's done on a group level like that, though, we generally see it's a little bit more expensive, and sometimes a lot more expensive than doing it privately. So if there's a person that's anywhere near average health for their age and being a male or a female, we've seen for the dollars that they're paying for supplemental coverage, the ability to get private life insurance and see their coverage increase by 2, 3, 4, and even 5 times the benefit. And when we're talking about life insurance and any insurance for that fact, we really want to get the right coverage in place first and foremost. And then we want to find who is going to give us that coverage for the best bang for our dollar. So it's not a one-size-fit-all sort of scenario. Again, these are things that we always want to help out with and shop this out. Being part of AXA across the state, you guys have access to almost every single insurance company that's open for business. So we're able to go shop around through AXA, through John Hancock, through MetLife, and make sure that someone's getting the best bang for their buck on their insurances. So how much life insurance does somebody need? So you see a lot of statistics out there, and we hear anything from 10 times to even 20 times someone's income. But we look at this as being like 7 to 10 times someone's income should be a bare bones minimum. Even through New York State, you get 3 times your salary, right? But the problem with that is, first of all, it's only 3 times your salary. But secondly, the vast majority of that is actually taxed at ordinary income rates to your beneficiaries. So through New York State, it's only the first $50,000 that gets passed along to your beneficiary, like regular life insurance does, as in it's tax-free. The rest of that is fully taxable. So if someone makes $100,000, it's a $300,000 death benefit, but only $50,000 goes tax-free, and the other $250,000 is taxed just like a paycheck. And when we look at what our pensions are worth, putting all these years of service in and the money into the pension system, that 3 times the salary, because that's in lieu of the pension if someone doesn't make it till retirement, it is nowhere near the value of what that pension's actually worth. So we want to make sure that we're protecting these very, very, very valuable assets, such as our New York State pension. But the U.S. Department of Justice used the following criteria here to calculate the amount of compensation to distribute to the family of 9/11 victims. So anybody who passed away in 9/11, they got 12 times their income, and these were with couples without children. And they received 20 times their earnings if they were survived by a spouse and had minor children. Everyone's financial situation is different. So there is no one size fits all for life insurance. Everybody has different goals. Everybody has different needs. Again, the most important thing is to get in place the correct amount of insurance to take care of the things that you would want to take care of if you're no longer here. And this is something that we can always help out with and really talk about the two different needs when it comes to life insurance. There's the immediate need, and then there's the ongoing needs. So the immediate needs, just like it implies, it's, final expenses, maybe taking some liabilities off the table, paying off the mortgage, setting aside a college education fund for the children. But the ongoing needs are something that when we look at what is actually needed to continue running a household, if someone's income isn't coming in every single week, month, year, it starts to add up. And we just want to, again, make sure that everyone's aware of the amount of coverage that they have, whether it's given through the state, whether it's privately purchased, and know exactly what it's going to be used for. So our next topic here, it's going to relate to different investment strategies. So myth number 6, investing is too complicated and time consuming. Many people, just starting out think investing is extremely complicated, very time consuming, and they really don't have an interest in becoming an expert in the stock market. But you don't have to become an expert. So as long as you have an idea of what some of your financial goals are, and this isn't something that you have to pull out of your pocket right now. And these are things hopefully that you're talking with, family members about, people that are important to you about, and then also with financial advisors to chime in and work together with you to help you determine what your financial goals are. But the truth is, investing can be complicated and time consuming, but there's a lot of resources out there to help develop a strategy. So the financial strategy really depends on your needs. It doesn't have to be very complicated. It just starts with your needs, your goals. And once you know what you're trying to accomplish, you can then gather information, whether it's publicly or working with financial professionals like ourselves, and always make sure that we're updating things. Things are always changing, as we've seen over the last, we can call it 1 day, 2 days, or 2 months out there in the stock market. We always want to make sure that everyone's accounts are up to date, that they're in the right places. But we also know that things take place in our clients' lives all the time as well. So we actually require a commitment from all of our clients that they meet with us at least one time each and every year face to face to review, yes, what's been going on in the markets, but also what took place in your life, because there could definitely be life events that might not seem the most important to someone's financial future. But when we look at things, we might say that it is, and we might actually shift some of our recommendations as we meet year by year. We're going to switch gears now to retirement planning and hopefully living the retirement dreams that we all have. So myth number 7 is, I'm about to retire and I need to move all of my money into CDs and bonds. So we actually come across this scenario a lot in some of these conversations. It's not exactly the way to go about it, though. Retirement's really just a new stage of life. And today there are higher standards of living and medical care. People are living longer and healthier. If you were 60 years old in 2018, the average you can expect to live is another 23 years. That's a long time. So you have 20 plus years to enjoy life, and your retirement money really needs to start and continue to work for you. So how do you do that? So first you have to, again, look at your own and your family's personal situation. What are your needs? How comfortable are you with taking on risk? What is your health? Do you have a history of longevity in the family? What are your investment objectives? Do you have any experience with investing, or what are your expectations when it comes to investing? What are your assets worth? and where are the funds coming from to help you live that retirement lifestyle. This is one of the most important things to take a look at here, is that there are different income streams that are coming into the household, some by choice and some by force, right? So when we retire from New York State, that New York State pension's coming if we're, at the proper age. Then we have a choice. Do we take Social Security at age 62? Do we wait until our normal retirement age? Or do we push it off even longer, potentially to age 70? When we do start to pull money from our accounts, are we going to look to our savings account? Are we going to look to our 403b? Maybe we have a Roth IRA out there. There might be some other, brokerage accounts out there with individual stock holdings, or maybe some non-retirement assets. This is really the most important thing, is to figure out, and this is what we help our clients do, is where the money is going to come from on an annual basis to keep more money in your accounts, in your pocket, and pay the least amount of taxes that you possibly can. And we want to make sure that someone's standard of living will be there for them, something that they want to achieve for the long haul. And if we go through a planning process and we say, based off of what's going on right now, and you want to retire at age 58, and we want to live on X amount of dollars per month, there could be a little bit of a shortfall. And our recommendations have to gear toward, now, how can we make sure that our retirement assets last us for our entire life to live the retirement lifestyle that we want? And sometimes we look at clients' accounts and their portfolios and compare it again with their needs and the softer information out there and say, hey, we've built enough money and we have basically got to this point where we can retire, not take on a ton of risk out there, and live the retirement lifestyle that we want to live. And that's why our recommendations would switch a little bit and maybe get a little bit more conservative in that sort of fashion. Myth number 8 of 10. I can't retire when I plan to because my retirement income is in jeopardy. So many people, employed, self-employed, believe their retirement income is in jeopardy and they can't retire when they plan to. It's definitely a concern, especially with what we've seen in the market over the last couple of years. We want to make sure that we create, though, a retirement budget based on your expectations. So where will you live? How much money are you going to need on a monthly basis? And what sort of incomes are going to be coming on a guaranteed basis? What sort of incomes are going to be coming by choice? These are things, again, like Social Security, New York State pension. Maybe there's some rental properties out there. Potentially someone could have an annuity or two that's also guaranteeing some more income for themselves and families. It's all about planning when it comes down to this. And we just want to make sure, again, that everyone has the tools in place to be able to retire and live the retirement lifestyle that they want. So almost finishing up here, it looks like we're going to have a couple minutes for questions. Myth number 9, when I retire, I'll just sell all my assets and collect the money, and the order that I do it does not matter. We've hit on this a little bit right now over the last 2 myths, actually, but the timing is so important of where you're taking funds from and the types of accounts that you're taking them from. 401ks, 403bs, when money comes out of those accounts, it is actually an IRS regulation that 20% federal taxes are withheld. So in retirement, that may not be the best place to be pulling money from if you don't have to. 403bs, 401ks, generally we see them go into traditional IRAs. At that point, we have full control over our taxability on that in terms of how much we want withheld. So we can zone in on exactly what our tax bracket's going to be and say, well, we don't want to withhold 20% in taxes because we're only in the 12% tax bracket. Yes, if we withhold 20%, we do get that back come tax time. But what did we just do for that whole entire year, January, February, March, April, whenever you do your taxes the following year, as we just gave Uncle Sam an interest-free loan for that time frame. And that money then is not in your account to continue to grow and gain interest. So there's all of these things that come together, and we can talk until we're blue in the face about rates of return and expense ratios. At the end of the day, yes, all of that stuff matters. But when we can look at some rules such as the tax code or the IRS regulations in terms of taking money from different types of retirement accounts, these are a little bit more black and white that, again, we can plan to take funds from the correct areas to help you keep more money in your accounts and out of Uncle Sam's pocket. So the last myth we're going to talk about today relates to estate planning. Very, very important topic here. So myth number 10 is everything in my estate will automatically go to my spouse and or children. There are many tools that you can use when it comes to estate planning. A will is probably the most essential, though. It's a way to choose who will get your property rather than leaving it up to state law. A will distributes that property according to your explicit wishes. So you can leave property to a spouse, a child, relative, friends, a trust, a charity. This is something, again, we would consult with, either an attorney that you do work with, and we do have some attorneys on board here with our group. But it's so important to have all of this set up properly, and most importantly, just designating beneficiaries on all of your accounts. We've unfortunately seen some circumstances where, let's just say that it's two children who are the beneficiaries or should be beneficiaries of accounts, but one might be the executor or executress of the estate. And we've seen in retirement accounts that one child is listed as the beneficiary, and the plan is for that child to distribute the assets. Again, if there's two children, half for them, half for their brother or sister, let's just say. But in retirement accounts, it's not that easy. So if one child is left as the beneficiary, any money that comes out of that account, it cycles through their tax bracket. So it's very, very important that if there's multiple beneficiaries, if accounts are supposed to go multiple places, to list. It could be 2, it could be 3, it could be 4, 5 primary beneficiaries, and then always putting contingent beneficiaries on these accounts as well. So in summary, you can make the best decisions if you're armed with the truth and not the myths of a lot of these different planning topics here. And just by being here, obviously, this stuff is important to you. Hopefully you've been able to arm yourself with a little information or some different topics that you'd like to learn a little bit more about and how it applies to you. But the most important thing is just to plan. And, the future is, the security of all of your assets here, and the family really depends on it. So the decisions that you make now, the things that you put in place, the goals that you have, the wishes that you have, it's just conversations. And from that point, it turns into planning. So you're able to definitely do it yourself. You can definitely go on and find a ton of information at a lot of different places. You can certainly work with someone from AXA across the state. But the most important thing is just to not procrastinate. Timing is very important. And just getting, again, the conversations out there of what's important, learning about it, and putting the things in place that you think are right for yourselves and your families. That wraps up the 10 myths. I think we have a little bit of time left for some questions, so I know I'll turn it back over here to see if anyone has typed in any questions.
Yeah, Alex, we do have a question. The question is, with a Roth, is the initial investment and the growth not taxed, or is it only the original amount not taxed and the growth taxed?
Good question. So a Roth IRA is funded with after-tax dollars. So money that came from a paycheck, it's in someone's checking account, they contribute that to a retirement account. You don't get a tax break for that right off the bat. So if you put $1,000 in, you just put $1,000 into a retirement account. That money will grow until you take it out in retirement. And no matter what that dollar amount is down the road, all of it comes out with no tax consequences whatsoever. So it's so important to talk about these different vehicles a year and retire. I mean, you might not touch your Roth IRA, and you might take a lot of money from it. It's all about staying in the lowest possible tax bracket that you can. And Roth IRAs are great because it gives you the ability to pull income in retirement, and it does not affect your taxes whatsoever.
Okay. The only other question we have right now is, can we get a copy of the presentation? And yes, so Alex will send that to me, and I'll post that to Sainies.org along with the recording of this entire webinar, and we'll get that to all the registrants.
Great. Yeah, I'll shoot that right over to you, Michelle.
That'd be great. Any other questions before we say goodbye here today? I think that's it. So thank you very much, Alex. And
great. Yes. Thank you, everybody, for joining in with us today.
All right. All right. We'll hopefully chat with you all next month for next month's webinar. So long.
Great. Sounds good. Have a nice weekend.